First of all, I would like to invite all FinPros members. Good evening. And apart from FinPros members, other guest who has joined in this webinar, it gives me immense pleasure to welcome you all in this today's FinPros webinar. As you know that FinPros has been created with vision to build a circle of CFOs, finance leaders, and professionals who can come together, not just to network but to share knowledge. As you can see this in our group's description also, we can inspire each other and grow stronger as a community, and uh, to grow stronger, to share knowledge and inspire each other. Uh, we do conduct an in-person event also, monthly in-person event. Uh, Till now, we have done this in-person event in Chennai, Hyderabad, and Mumbai. We are getting more and more requests to do this in-person event in other cities also. Very soon, we have planned to do it in Bangalore and Delhi also. Now, coming back to today's webinar, as you must be aware that there has been recent changes in GST effective this month. So, and after that, there was a strong demand from our group. We were getting messages in our group to have one session in GST. And when it comes to GST, first person who can come to my mind is CS Shravan Gehlot, who is speaker of today's webinar. I have been I have been knowing CS Ravan Gehlot for maybe more than 2 years, or say around 3 years, where uh, I mean, we had availed services for our company where I am presently working. That is a pharma company, and we had availed. We had a really very good time getting services of CS Ravan Gehlot. CS Ravan Gehlot is a fellow member of ICAI, and he is co-founder of Protaxology Advisors Private Limited. And CS Shravan Gehlot has also joined our in-person meeting also in the past with his all other partners. Shravan brings 10 years of expertise in indirect taxation and EXIM consulting, having earlier worked with PwC for 6 years. His specializations are GST, customs, SEZ, and foreign trade policies, where he has enabled clients to secure over 1,000 crores in GST refunds through innovative credit and liquidation strategies. Shravan has conducted more than 50 lectures across India in ICAI, then NACIN, CGPI, BCA, and other industry forums. He has been giving training in central and state GST offices. His contribution is including co-authoring ICAI's practical FAQ on GST, reviewing their handbook on advanced billing, and serving as co-opted members of uh, ICAI, that is the Institute of Chartered Accountants in India, uh, their indirect tax committee, that is Southern Region, SIRC. He is passionate about knowledge sharing. Shravan also moderates large professional forums such as GST Knowledge Forum and Customs FTP and SEZ forums, where thousands of members are actively discussing the latest in indirect taxation. He was recently recognized as best faculty by NACIN Chennai. So I am welcoming CS Shravan Gehlot to share his knowledge on GST. Welcome, Shravan Gehlot. Now stage is yours. Please
Thank you, sir.
enlighten
Thank
us.
you. Thank you for your kind words and introduction. So I will, set the context very clearly. I know the rates have been implemented from 22nd, and most of the companies, have been implemented, but there may be certain questions which they will get to know, or they will be aware only when the monthly compliances comes into picture. So what I have done is I'll be covering. See, let us be very clear. I'll be focusing on certain areas which are already being known to you because of the wide coverage and media coverage of this particular change which has happened. And apart from that, we will focus as to what we have to do when these changes are coming into picture. What is the impact on ITC on account of this particular changes in GST 2.0? Then what are the measures which has been taken by government in relation to the trade facilitation measures? And what I believe are certain measures which has not been taken into account by GST, or they should also consider taking it, so that this reform of GST 2.0 becomes historical for that matter. So first of all, everyone are talking about the rate change. That is 5 to 0 to 5, 5 to 0, 18 to 12. So what is the rationale? What is the rationale of that particular change? One is to eliminate the classification criteria. But if you look at from the revenue angle of GST government for that matter, if you see, this is the chart of 23-24, wherein we have prepared an RTI and got an information of what is the percentage by slab benefit or revenue which is going to the GST government for that matter. If you see, majority of revenue is flown from 70 to 75% of revenue is from 18 percentage. Okay. And 512, which is also available erstwhile, was contributing only to the extent of 5 to 6 or 6 to 8 percentage. So eventually there was a lot of classification available, but the revenue was flowing only from the majority 18 percentage. That is why if you see 5 and 12 has been moved to 18, or 5 has moved to 0, or 12 has moved to 18, and 28 is ultimately removed from the ambit of GST. So why it is important for us to know is, government wanted to first understand where is the revenue coming from, and what is the objective of having so much of rate if there is no revenue coming from that particular department. 1 minute. So this is the rationale, as to why government has first decided to change the rate of tax, change the rate of GST into two particular criteria. So this is a rationale in which the government is seeing the revenue flow from the thing. So even in spite of changing this, if people believe that the revenue of GST will come down, my answer is no. There will be higher consumption, and in addition to higher consumption, there will be also the as you see, the revenue of 18% is such 70 to 80%, and most of the rates as on today is 18%. So the at coming down the line and seeing the festive season, the revenue is bound to increase. Given this background, let us understand what are the actual theme of this change in the GST 2.0. One, the rate of GST has been simplified. The standard rate is 18%, as we have discussed in the past. The merit rate is 5%. Still, there are certain goods, which is basically the daily consumables, medicines, daily medicines, life-saving medicines, which are taxed at 5%. And there are certain demerit rate, which is 40%. So government, what they have done currently, they have selected certain sin goods and luxury goods and treated the same tax at 40% by clubbing the compensation cess. So what is the objective of government? One, as I told you, revenue streamlining, which is the prime objective, where government is able to see that the most of the revenue are coming from 18%. So let us retain the same and done away with all the classification disputes which was available. Because if you see the classification as on today, there are a lot of rates. For a similar product, there are multiple rates. Let us take an example of, let us take an example of GTA for that matter. So 12%, 5%, 18%, three things were available. So the industry had a confusion what rate to apply, what conditions are to be taken into account. So what government has done, and let's take an example of paratha. So paratha was different. It was taxed at 18%, it was taxed at 5%. So government don't want to, take the matters to classification. So if you are aware, classification matters only can be taken and handled by courts. So they want to done away with the disputes at first level itself. So they have rationalized the rate in such a way that there is minimum tax rates available, and there is no confusion for the same set of services, same set of goods with minimal changes. They will be clubbing everything under one particular rate. That is the main objective of taking this forward. Second thing is, compensation cess, which is about to get over as per law on 31st March of 2025. So government is also projecting to remove that compensation cess until the state's revenues are being fulfilled. So they are planning as to how the rates can be rationalized after the compensation cess comes out by increasing the base rate of the GST coming into picture. Given this background, now I have just highlighted certain rate changes which has happened, which you guys are aware. Basically, certain common man items rates have increased from 12 and 18% to 5%, which includes but not limited to hair oil, toilet soap bars, toothbrushes, other household articles. The objective is to, in the way the government has projected and the way the government has showcased right from the Independence Day, that they want to give the benefit of some kind of Diwali gift to the ultimate consumers. And this is how the notifications have also come out by giving the benefit of rate reductions in certain household consumable items. A good thing about this particular rate change is mostly the food items, which were ranging from the tax of 5, 12, and 18 are now coming under 5% ambit. Either it is 5% or they have made it nil by way of exemption. So this is the second criteria. And one of the most demanded thing by opposition was to make the insurance, that is mediclaim insurance and life insurance, as nil. Why they are charging 18% on such kind of services which is a need of a common man? But they have made an exemption. No doubt the benefit will come to the customers or the end users, but the benefit may not be 18%. Please understand, exemption as such is not good for taxation. Whenever there's an exemption entry, the flow of ITC is getting adversely affected. That means the input tax, whatever we were earlier eligible, is not eligible now, because the outward supply is exempted. So the cost of provisioning of services increases. So if you compare your premium prices also post September 22 and pre September 22, yes, the benefit of reduction might be there with you, but it will not be to the extent of 18%. It will be ranging somewhere from 7 to 12%, because the cost of company not availing ITC because the exempt supply, because the particular service is becoming exemption, that particular cost of GST will be added to the cost of servicing the company. So this is one of the elements which has to be seen very clearly. Exemption as such is not good for taxation, but there may be certain benefit which the individuals will get, which the companies are working out. And I think a lot of insurance companies have already rolled out the advertisement as to what is the revised pricing after September 22. Then there are certain life-saving medicals, which is I don't want to go into the nuances of medicines, but there are 33 life-saving medicines for which the rate of tax has come down from 12 to 0. In addition to above, there are certain rate of tax with life-saving medicals of cancer, rare disease, and several chronic disease, where the rate of tax has been reduced from 5% to 0. In addition to above, there are certain manufacturing equipments, medical equipments manufacturers. For example, if you see in any hospital, there are certain equipments which is required for the purpose of running an hospital. Those manufacturing of finished goods, hospital medical devices, the rate has come down from 12, 18 to 5%. So this isn't in health sector how the health and insurance sector has been impacted. Third is the coal. Currently, the coal was taxed at 5 plus 18% cess. So now what they have done, they have actually increased the rate of tax to 18% with by removing the compensation cess. So basically, compensation cess element, whatever they were taxing earlier, 400 per ton, now they have merged the same with 18% of GST. So what is the impact? The impact is currently for those companies who are involved in procuring coal directly from an importer, they will not be allowed to take cess as a credit, because their finished product will not have cess as the liability. Let's just take an example of steel sector, wherein the finished product will not have the cess as their outward liability, but their inputs will have a higher element of cess. So earlier the cess was considered to be a cost for manufacturing. Now, after the cess element has been merged into as GST, that element of cess which has been merged as GST can be taken by the ITC. They can be taken as ITC by the company, which will eventually reduce the cost of that steel getting manufactured. So ultimate beneficiary will be the construction companies or that particular end user who is purchasing the steel from the steel manufacturing company. Third, some rate revisions have happened, wherein GTA, they have given the benefit of 5% without ITC. but they have removed the 12 percentage element and they have moved the same 12 percentage with to 18 percentage with input tax credit. There was a confusion whether 5 percentage without ITC is still available or not, but it is very much available. Only the rate of tax of 12 percentage with ITC has been moved to 18 percentage with ITC. Cement, again, the rate of tax has decreased from 28 to 18 percentage, and all consumer electronics products like air, all those things have been moved from 28 to 18 percentage. So I think you should be aware that yesterday I think I read a news article wherein Maruti Suzuki and lot of other auto sectors have broken past records because of number of days of number of cars sold in a day. I think 35,000 odd cars have been sold, and which is it has broken all the records in the past. The major impact was GST, and major attributed reason was GST, because the rate of tax for small cars have reduced from 28 to 18 percentage, and many people were waiting till 22nd, and after 22nd they went to the dealer showroom and they purchased, and it was a record for most of the OEMs. In addition to above, commercial vehicles have reduced from 28 to 18 percentage, which will again benefit the commercial element of renting and leasing of motor vehicles. Given this background, what are the changes which is happening from the service element? See, basically, if you see job work, what is job work? Doing certain services on goods owned by others. So pharmaceutical products, hides, skins, and leather. These are the major segment which relies on job work. So instead of charging 12 percentage on the service charges, they have reduced the rate of job work to 5 percentage, which will eventually reduce the cost in this particular segment, passing on the benefit to the ultimate consumers. The hotel accommodation service, again, they have reduced from 12 to 5 percentage without ITC for seven service value up to 7,500. So as I told you, government is not appreciating any of the sin goods and something which is not in accordance with the provisions of the law, like betting, gambling, lottery, online money gambling, which is basic or any specified actionable claims. The rate of tax is now moved from 28 to 40 percentage. One interesting thing is they have changed the admission to sporting event. Basically, there was a separate entry available wherein admission to any event will be taken into account. But now they changed an entry that IPL and any similar to IPL will be taxed at 40 percentage, and other events which is not a recognized sporting event by Ministry of Sports or anything will be subject to 500 per ticket shall be exempted. Over and above 500 will be 18 percentage. So IPL, watching matches in IPL at cricket stadium will going to be expensive, seeing the notifications in place. So now what we have seen, we have heard, Shravan, you're talking something which I have heard over the last 2 weeks continuously on this particular news channels. My consultants are telling, my product team is telling. But what are the things we should take care as a consumer, as a consultant, or as a business person? First thing is, effective date of implementation is 22nd of September 2025. All the notifications which we have seen in the past in the previous slides are getting notified in 22nd of September, except for certain cases like tobacco products, cigarettes, chewing tobacco, zarda, unmanufactured tobacco, and new rates later they will be. What is the objective? Because these are the commodities currently the cess is applicable. Okay, so central government is yet to close the loan or compensation cess deficiency to state government. So these particular notifications for these products will be moved only when they are able to fulfill the compensation cess and the arrangement what the state and central had. Until then, these particular old notifications will prevail for these things. One more thing, what has happened in this particular sin commodities are the valuation has been changed. Earlier, whatever is the transaction value under GST is required to be paid. Now they have told, irrespective of the transaction value, what is the MRP, retail sale price, on the GST is required to be paid by the manufacturer. That means it is not on the transaction value what the manufacturer is selling to the dealer. It will be basically the retail sale price on which the GST is required to be paid. This is basically on effective date of implementation. So as we speak today, it is already affected and 2 days have lapsed. 2 days has been over in this regard, and people have implemented this particular GST rates in respect of the discussions what we had in the previous slides. Now, what is the benefit you are getting as a consumer? And how will you evaluate whether this benefit is actually being given to you? So let us take an example. And before before rate change, the GST was at 18 percentage. So the total cost to the consumer was 1180. After the rate of GST, assuming the rate of GST has come down from 18 to 5 percentage, the total cost to consumer becomes 1050. So the GST rate benefit of 130 is something which is flowing from a common man's understanding, considering that cost, sale price and the base price remains the same. Now, How are you ensuring as a businessman that the benefit has been given to the customers? How are you ensuring as a customer that the benefit is actually given to you? Or if the benefit is not being given to you, is there a mechanism available under the GST law to raise a complaint against the particular person who is not passing the benefit to them? And what are the things as a consultant or we have to take ensure that things are in place so that tomorrow, because please understand after 22nd this particular month's return is very critical for those industries where the rate has changed, because till 22nd the rate of tax will be some, and after 22nd the rate of notified rate of tax will come into picture. So given this background, we have to understand what are the things we should keep in place ready or the workings ready so that tomorrow even if department comes and scrutinize the rationally for revenue drop or for collection drop in GST from that element of that particular taxpayer, are we having sufficient workings available as to what rate change has happened, what is the impact, and what are the benefits we have passed on to the customers? That is something we should keep always have in hands, because there may be, not now after 2 or 3 years when department comes to know about this change and whether they'll ask mustering to us whether the benefit has been passed on to customers or not. So that particular workings are required to be, available with us. Given this background, first question which comes in, are there mandatory provisions under the law wherein the benefit is required to be passed on to the customer? As we speak today, if at all, this particular benefit in our example of 130 rupees, is it passed or not? And if it is required to be passed, is there a provision available or not? If the benefit of 115 or 130 in our example is not passed by the company or a dealer, and they are getting increased profit, it is called anti-profiteering. Okay. So under the GST law, there is a provision available which talks about anti-profiteering and how the company should not get themselves anti-profited. But however, there was a sunset clause for which the particular provision wherein a recipient or a customer can raise complaint only by 1st of April 2025. That means you are given to understand that the benefit has not been passed to you. You as a consumer cannot raise a complaint because the sunset clause is over and there is no mechanism available under the GST law for which you can raise complaint with GST authorities. However, why the business are required to transfer? But having said that, the law still avails, the provision is still available wherein the company should not be itself anti-profited by way of reduction of ITC or reduction of liability. But many businesses, if you see, are expected to pass the benefit to reduction of customers suo moto. Why? Because there is lot of monitoring happened by legal metrological lab, MRPA division. Then CBIC himself has asked a lot of taxpayers and a lot of big auto sectors as to what is the revised MRP you are putting into picture. So businesses, if they are not complying with this rate change and if they are proposing that they not be passing on the benefit to the customers, then they will be actually inviting themselves to a trouble. Second, as I told you, one of the competition is one of two automobile sector, one person not passing and one person is passing. Then obviously the competition pressures to attract the customers at lower price of time. Then they will be passing on the benefit to the customers. And obviously, if they don't pass on the benefit, then the reputational issues of the brands will come into picture. So irrationally, they will be required to pass on the benefit. So the benefit can be calculated only by keeping the base as same. For example, in our example, the base price will be same. On that, whatever is the GST change, that particular benefit is required to be given to the customers. So now there has been a lot of circulars issued by legal metrological department as to how the MRP is required to be disclosed and how can know whether there is a requirement to reprint the MRP or what can be done. There have been there was a lot of circulars, but finally the circular has clarified the only things that there is no requirement to affix a new sticker of new MRP and the old printed MRP will deem to be an old MRP. If that is being complied and that particular pricing sheet, if we are sending the same to the dealers, the distributors, the customers, and the respective division of government, then it is sufficient compliance in terms of the manufacturer. So this is an example which I'm trying to tell. For example, old rate is 5% and on account of the cost of service, if they're passing on the benefit of 4.76 to customers, then the revised MRP of 95.24 is required to be printed in the commodity which you are purchasing after 22nd of September. So if you see here, the rate of tax is old is 12%, now it is 5 and the benefit of 6.25 has been passed, then the printing element is required to be taken care by all FMCG or all the companies where the products are sold on MRP basis. There is a clear cut instructions given by the government. So this is the background as to what benefit and what are anti-profiteering and what we have to do from an compliance perspective to ensure that there is no issues falling on us. In addition to above, there are a lot of transitioning. That means you might have supplied goods on 15th, the invoice might be raised on 23rd, or there may be instances where the payment has been received before 15th for service provision of services, but you are actually raising an invoice in the month of 24th of September. For example, there may be instances of a lot of professionals like us who will take advance for tax audit and before September 22nd, but eventually they will require to raise an invoice. As you are aware, under GST, advances is subject to GST. So that point of time, they might have paid 18%. Now they will be raising an invoice after completion of tax audit, which I suppose to be completed based on the extended due dates proposals by government. After 30th September, then the due date, the new rate, even if it is applicable, then what should be the rate? All those things will come into picture. So now what we can do is I've just prepared a small table wherein how can we determine the GST rates during transition. So there are three criteria. Okay, supply of goods, date of invoice, and payment date. The thumb rule is mostly the GST rate will be based on the date on which the invoice is raised, irrespective of the fact whether we supplied goods before or after, or whether the payment has been received after or date, provided the invoice has been raised within 30 days from the date on which the goods has been supplied. If this particular criteria is seen, mostly our thumb rule should be based on the date of invoice only the rate will be applicable. For example, if I mentioned the supply of goods before and date of invoice has been after the rate of change, payment has been received after the rate of change, then invoice date shall be the new rate. This is basically in the case on sale on approval basis where the goods will be supplied subject to approval and they agree, and then after that invoice is raised, then the new rate will come into picture. Assuming you have raised an invoice before, goods are also supplied before, and payments has been received after, still the invoice date is criteria for us to determine the GST rate. Since the invoice date is before, then old rate will come into picture. Similarly, I've given the examples wherein if you received the goods after, when date of invoice is before and payment date is also after, still the invoicing date, which is basically the before GST rate, will be applicable in this case. So this is basically a transitioning affair which is applicable for this particular week, wherein though a lot of companies might have any of these criteria before or after. So there is a provision available under GST, which is section 14 of CGST Act, which talks about the mechanism which should be implemented by the company or by the taxpayer, in which rate should apply in those instances. Similarly, for services, the rule changes a bit here. Here, the majority rules prevail. Majority rules means in case of supply of service, DT, date of invoice or payment date. In this, what is majority? Is it the sequence of event is happening after the rate change, or sequence of event is happening before the rate change? Any of the event is happening after. For example, in our first example, the supply of service has been done before the rate change, but date of invoice has been happened after the rate change, and payment also has happened after the rate change. Then because there are majority, after the rate change, two things have happened, the new rate will come into picture. Similarly, in our second example, where supply of services happened before, but invoices are issued before, but payment is received after. But because there is two majority things coming up before this, the invoice date will prevail and the old rate will be applicable. See, this majority rule, all those things we have just formulated for better understanding in supply of service, date of invoice, and payment date. But legally, the language is worded in such a way that time of supply should be either of the date of receipt or supply of receipt or payment date, whichever is earlier. So on that basis, we have clubbed this and prepared and documented it so that it becomes easier for companies to implement it as to which rate they should apply during this transition phase of next 10 days. That's all. I don't think so. After 10 to 12 days, there will be a criteria in respect of which these transitioning provisions are required to be seen by the companies. Now, some of the common questions which comes to any professional or any company is, I am supplying goods before the rate change, and the goods are returned immediately after the rate change getting implemented, that is 23rd of September 2025. Now, when I'm returning the goods, obviously I'm required to raise a credit note. Whether the credit note I'm required to raise in the old rate or in the new rate, the answer is very clear. We have to issue only in the old rate, because the taxability, see, credit note as a concept under section 34 is allowed only under certain situations. At the time of raising invoice, you have discharged the tax levy of 18%, and when you are raising credit note, tax for that commodity is 12%. You're not required, you're not, it's technically not correct to raise invoice at 12% or 5%. You are required to raise invoice credit note only for the rate of GST what you are charged for the particular invoice. Second is transitioning EV bill requirements. I have already generated EV bill before 22nd, and my goods are in movement. It is going from Chennai to Rajasthan. So, am I required to generate a fresh EV bill? The answer is very no. FAQ also has clarified there is no requirement to generate any fresh EV bill. The EV bill generated in advance will only work. Now, advances. So, I have paid, as I told you, we have for GTA. If I'm paying some advances and I'm paid GST at the rate of 12 percentage, whether at the time of raising invoices, should I pay at 12 or at 18 percentage? They have mentioned very clearly that as per time of supply provisions, the applicable rate at the time in which you're raising an invoice only will be applicable. That means the time of supply will be prevailing. 18% is required to be paid. And what should we do for new stocks on hand? This is an important point. Inventory planning is what we call in manufacturing. There are a lot of inventory available for which I have suffered the tax. I have availed the ITC, assuming that my ITC rate, my rate is 18 percentage. Now, as on today, the finished goods are ready, but the rate of tax is 5 percentage. What should I do for the goods which are manufactured? The answer is very clear, because the time of supply provisions are framed in such a way it is linked to a supply, and because the supply is happening on or after the date of implementation of notification, which is 22nd of September, the new rate will come into picture. It will not be the old rate. The customer manufacturers are required to pass on the benefit to the customers, and that is their internal workings and numbers with OEMs as to how that particular loss can be compensated by them or not. This is the basic transitioning provisions which are basically relevant for you to know as to how to take into account. Then what are the other key considerations? One thing is, yes, as on today, if we are speaking, I'm assuming all our ERP has been changed and configured in such a way that the revised rates are coming into picture. Right from manufacturing, service, whatever rates have been changed, that ERP and accounting has to be changed so that there is no issues in the compliances. Now, if at all we were supplying certain combos and bundles on a mixed supply or a composite supply, we have to realign the classification as to see that whether there is any change in the principal element of that particular supply. Now, discuss with business partners with stock held with them. Then major thing which is impacting a lot of companies, particularly insurance and particularly those sectors where the rate of tax is 5% without ITC. So under GST law, whatever ITC you have taken, there are two kinds of goods. One is inputs, second is capital goods. So there is a requirement that whatever ITC you are availing on capital goods is required to be reversed on 5% proportionate every year in accordance with Rule 43. So now what has happened, as on today, if we speak, the company might have availed the ITC assuming that particular goods are taxable, services were taxable. Let us take an example of mediclaim. They might have purchased some goods assuming the goods are taxable and they have availed the full ITC of capital goods. But as on 22nd of September, we might have everyone are aware that exempted, these particular services are exempted, and the companies who has transitioned from taxable to exempted are required to compute the ITC which has not been reversed by the company on account of capital goods, because any company who is supplying exempt supplies are basically not required to avail the ITC, and if at all they have availed it, there is a provision under the law which is 18(4), which they mention very clearly that ITC which is not reversed by the company on account of these exempt supplies are required to be reversed. Second, impact on GST credits. See, take an example of an auto sector client. Oh, so they have merged all the cess. That means cess is part of GST now. So GST has been cess has been subsumed in GST. So as on today, they might be having a lot of accumulated ITC cess, which is lying in their electronic credit ledger. But they will not be having any outward liability on from 22nd of September, because the outward liability of 18 and 12 percentage now has been taxed as GST. There is no element of compensation cess. So what will be the plight? What will be the scope of that ITC? Whether government will come with any provision to relax that particular ITC to be claimed as refund, or whether government will give a transition provisions for that particular ITC, because this particular ITC should be passed as ITC in respect of other GSTs. As on today, the answer is no. There is no benefit available as on today. Strictly speaking, as per the law, the ITC which is remaining unaccumulated as on today is a cost to the company, and they will have to charge off. There is no liability available. But having said that, there have been a lot of representations going on from auto sector to government, because the quantum of ITC on compensation cess is huge, and the companies cannot afford to take that. One side company is giving the benefit of rate reduction to the customers, and one side they are taking a hit of compensation cess on them, which may not be practically and feasible for them to take this forward. So let us see if there is any relaxation coming in this regard, or government is coming with a transitional provisions to provide refund of that compensation cess to auto sector or not, is the matter of time we will get to know. And secondary, because of rate change in renewable sector from 5 to 18, 5 to 12, and 5 to 12, and medical sectors from 5 to 18 percentage. And what is happening because of some rate reductions being given, okay, in respect of inputs, there is a higher scope of inversion happening. Currently, government was with an objective to remove the inversion from the entire domain of GST. But because of these rate changes, unfortunately, there are certain sectors who are again having a higher inversion, particularly renewable and medical devices manufacturer and textile sector. So how are the companies planning to dilute that ITC and inversion, which is cost on account of GST rate change, is something which the business will suffer on account of working capital impact. So having said that, now we will be focusing on certain key elements, specific element of what is the impact of ITC on account of this rate change. So generally speaking, the law is very clear. There has been a lot of doubts by the sector whether if there is any ITC availed by me on certain goods or certain services. And as on 22nd of September, my rate of goods has been reduced from 12 to from 18 to 12. Whether I'm still allowed to avail the ITC and utilize the ITC which is available in electronic credit ledger, the answer is very pretty yes. ECL is not there is no nexus theory, one-to-one nexus theory with the goods or supplies what they are having. Electronic credit ledger is ITC is something you have availed in accordance with section 16. There is a right, you have complied with the conditions. Even if there is a reduction in the rate of tax, you can very well avail the ITC. There is no requirement to reverse the ITC for a differential portion of reduction in the tax. That has been clarified in the FAQ. Now, as I discussed in the previous slide, all those companies who are involved in supply of food articles where the rate of tax is reduced from 5 to 0 percentage, medical insurance sectors, or GTA, or certain services where the rate of tax has been changed from 5 percentage without ITC, those companies are required to consider their supplies as exempt supplies and reverse the ITC whichever is available in the electronic credit ledger. And inverted duty structures, as I told you, in that medical devices, renewable energy are two major sectors where the inversion will increase. And we will see as to whether there is any scope available for the companies to claim that ITC as refund or not under the provisions of the law. I have taken an example. Okay. I have taken an example. So if you see here, purchase price is 100. Okay. And GST rate is 18. So ITC available before the rate change is 18. Now sale price is 120 and the GST rate is 5% for this particular change in rate of tax. So my GST liability becomes 6. So the question here is when my ITC is 18 and GST liability is 6. Okay. So I'll be having unutilized ITC of 12 rupees in my electronic credit ledger. So is there a way I will be allowed to, or I will be allowed to claim refund of this 12 rupees? Technically speaking, there is a provision under GST law under 54(3), wherein they have mentioned that if your output rate is less than the input rates, what has been used for the purpose of selling your output, then you are allowed to claim refund. Okay, that is as per the section available in the law. But there is a circular. Circulars are basically a procedure which is required to be complied by the tax officers or the taxpayers in relation to the refunds to be claimed. In that particular circular, they have clarified. Give me 1 minute, Paresh ji, 1 minute.
No problem.
Sorry. So as we were speaking on this example, There is a provision available under the law wherein if the input rate is higher than the output rate what we are doing, there is a provision we can claim refund. Okay. So now there is a circular. What has happened? They have issued one clarification in the circular stating that if my input, as we speak, take an example of an uh, car, or they take an example wherein one particular what's the example we take? We'll take an example of renewable devices itself. Okay, I am purchasing a renewable devices which is currently taxed at the rate of 18 percentage, and I am selling that. If that is currently after the rate of tax, it is changed to unsold stocks, which has been changed to 12 percentage. Whether for that renewable device which I am not doing any manufacturing, I'm just doing trading, there is no change in classification, I'll be allowed to claim refund or not. So the department by way of circular has issued that in respect of same commodity, if there is a change in rate of tax on account of any notification or implementation, that inversion of ITC, accumulation of ITC on account of such rate change will not be permitted within the purview of this circular. Having said that, this particular circular is, restricting the refund to be claimed under IDS. It is standing very much applicable for the officer not to give the refunds, but there are judgments available. So people have approached the courts because it's a huge working capital blockage for them, and they will not be able to do anything for that ITC what they're availing. They have approached the courts in the past, and refund has been held by various high courts, including Guwahati High Courts in case of BMG Informatics 2021, Rajasthan High Courts in case of Baker Hughes Asia Private Pacific Limited. So in all those cases, they have told that this particular para of circular, this particular circular para is invalid. That means that particular circular where they have restricted the benefit of not claiming refund of inversion on same inputs and output on account of change in rate is struck down, and refund was sanctioned by the higher courts in this particular criteria. So the question why it is relevant here today is because there is a lot of unsold stocks for which the rate of tax has been changed. Let us take an example of cars wherein they might have taken ITC at the rate of 28 dealers. They might have taken the ITC at the rate of 28, but now they are selling at a rate of 10 percentage. So what will they do of the 10% of ITC which is getting accumulated? As we speak today, circular is restricting, but law is allowing. So we have to assess and we have to wait whether any relaxation will be given by circular by government in respect of this circular by allowing this ITC for the same input and output where there is no manufacturing being involved. I believe so. My personal views are legally it is allowed. We should go ahead. We should fight and we should get the right that inversion as refund. And I also believe that government will come up with some issues and some reforms in this sector so that the benefit actually goes to the dealers and they're not, taking this particular inversion as cost for running their operations. Similarly, there is a lot of questions. I have already covered this particular element. What is cess? Is the cess completely composition cess is completely abolished? As I told you, from September 2022, all the compensation cess which was earlier applicable has been subsumed in GST. Currently, the compensation cess is only levied for pan masala, gutka, cigarettes, chewing tobacco, and all the sin goods, and it will be continued to be levied until the central government and state governments are able to settle their dues in this regard. So, this is one clarity in respect of whether the compensation cess is completely abolished or it is still operational. Second is whether the accumulated ITC cess which was available as on date for the purpose and after it is getting subsumed, whether the refund will be allowed or not. Currently, there is no legal solution for that. There is no provision available for us to claim refund of that ITC because of subsuming the access in the GST. But as I told you, I am of the view based on representations from industry also, either they will allow a special refund for this accumulated cess because currently there is no output liability, or there should be any mechanism where this particular cess is used by the automobile sector or particular sectors in availing ITC in the CGST, GST or IGST yet. So we have to wait only as on today, only representations are going from the industries who are impacted by this. So having said the changes, we have discussed the rate change, we have discussed the transitional provisions, we have discussed the impact to ITC, and now what are the rate? These are all particularly in relation to the changes in the rate of tax which we have discussed till now. The second element is what are the other things wherein they have changed the law or they have included an instruction which is facilitating the trade at large. So first is risk-based provisional refund. So let me give a background on this. So under GST, whenever an exporter is claiming a refund under of assuming for the export of goods or export of services, they were allowed to claim, they were allowed to get provisional refund of 90% on the refund what they're applying. For example, if I'm claiming refund of 10 crores, 10 crores, then 9 crores of refund will be eligible to me. But that 90% of refund was sanctioned to the exporter by way of a manual check done by the officer, whether that particular officer is satisfied, the exporter is non-risky, and all those manual process was applicable. Now they have proposed to change the law in such a way which is effective from 1st of October, 1st of November 2025. This entire process will be system based. That means automatically, if the system believes based on the past trends of the exporter, the compliance measures of the system, and based on they have some criteria. DGRAM is there to evaluate the risk criteria of all the taxpayers, and if they believe that the taxpayer is risk free, the ratings is good, then the system will automatically sanction 90 percentage based on this criteria. This is a very good boost for the exporters at large, because currently the mechanism of getting this 90% is itself difficult. I'll be very frank. In my practical experience, I'm not even seeing 90% being sanctioned by officers these days. They're sanctioning an ad hoc amount of 20 percentage, 70 percentage based on their wishes, based on their budget criteria. But as on today, I'm not seeing any of the exporters, central or state government, giving the 90% benefits to the exporters, which is very much available in the law. Because that manual control was available with the officer, the government has now shifted this particular manual control to system based, when the system will automatically give 90 percentage if the risk criteria are seen to be in line with the government. This is a very big boost and very big trade facilitation measure, wherein the exporters will get benefit of working capital and the refund will be given within 7 days. And after that, the usual refund process adjudication can be taken care within the upper limit of 60 days government has planned. Now, one interesting thing which I want to tell you is the provision of 90% of refund was available only for exporters. It was not available for a taxpayer who has an ITC accumulated on account of inverted duty structure. As I told you in the previous slides, inverted duty structure is basically ITC getting accumulated on account of inputs being higher than the GST rates of inputs being higher than the GST compared to the GST rate of outward. So whenever the taxpayer is having an inversion on account of this particular flow of transactions, what they are doing, they shall not be allowed to claim refund on provisional basis. They will get only refund on the 68th day or within the 60 days process available as per the law. Now, what government has done, they have changed the provisions in such a way by stating that 90% of the provisional refunds shall also be allowed for IDS refund claims. This is very important because lot of sectors, renewable medical devices, auto, as I told you, these are the two sectors, textile sectors, which will be having inversion, higher inversion, because the output rate was earlier taxed at 12 percentage. Now they have removed that, they have changed from 12 to 5 percentage. So there will be a higher inversion down the line for this from September 2022 onwards. On account of that, the companies who are involved in supplying such renewable and medical devices, medical manufacturing devices, they will be expecting to get that ITC encashed by way of refund. So they will be getting that 90% immediately. How based on system based, there is no manual control in this also. So it is a very good change for IDS refund and sectors which will have an inverted duty structure, which will benefit them in having quick cash flows for them. Given this background for the benefits, what has happened in refund, let us move forward in taking the GST registration. As we speak today, as a professional, I am facing lot of challenges in registration than any of the cases, let it be adjudication, refunds. But registration itself becomes so challenging. Officers are asking some set of documents which are not required in the law. Officers are coming for physical verification. Something or other reason, the registration was not happening the way it was projected to be happened by government, that within 3 days you will be getting. So now what has done, they issued an instruction as to what documents the officer can only ask. Beyond that instruction, they cannot ask any other document. In addition to that instruction, they have also told that if there are small and low risk businesses who identify themselves a low risk by the system, and the value of tax what they are paying per month is not exceeding 2.5 lakhs per month, then they will be giving the registration within 3 days from the date of application, and this provision will come into picture from 1st of November 2025. The best part of this is almost 80% of the new registered persons will be covered in this, wherein the tax liability, CGST, SGST, IGST is not exceeding 2.5 lakhs. So let us see if this gets operational. So majority of registration issues will also be sorted because we will be covered under the ambit of 80% which government is projecting. Now, this is a proposed change. This is not yet happened. This is not yet notified, but this is very important for our exporters at large. There are a lot of companies, ITES sector, shipping sector, and software sectors, research and development sector, wherein they were providing certain services because this particular service was coming under the ambit of intermediary services under GST. They, even in spite of the fact that the supplier was in India, the recipient was foreign currency, the recipient was outside India, they were earning foreign currency. But because intermediary, the place of supply was in India, the entire forex earning, whatever they were earning, they used to charge 18% on that. What was happening at an international level, India was seen as a country who was taxing exports, intermediary services exports at 18%. So government has, this discussion was going on for so long. In the last 2, 3 council meetings, it was discussed. Government has then finally decided that the place of supply for intermediary services, which are basically qualifying as an intermediary under GST, which is basically something doing on behalf of other person or acting as an agent. Those place of supply will also be based on location of the recipient. Currently, the place of supply is location of the supplier. In our example, as I told you, if I am in person in India and providing some services which are treated as intermediary services, but my customer is actually based out of Australia, then as on today, as the provisions are not changed, the place of even though I am getting foreign currency, I am meeting all the conditions of export. Just because the place of supply is India, location of India, I was not getting the benefit of exports and I'm required to charge 18% on the value of services. Now, because of the change in the provision, the place of supply will be basically the location of the recipient, which is Australia in our example. So it will qualify as export and there is no requirement to pay 18% on the supply. So that is a big boost for exporters of service again who are falling under the risk of intermediary. This will enhance the exporters market in India and enable that. I know at an international market, India is not looked as if they are also taxing exports. Given this background, let us move to something, a very good litigation which has come to a closure. If you see the trend, what government is doing, they are trying to settle all the issues, whatever they are facing or whatever they have faced till now, or whatever the industry is facing in terms of interpretation or in terms of the provisions of the law by way of issuing either a circular or by way of amending the law. So they had a clarity what will qualify as intermediary. They were not able to decide intermediary services whether this service will qualify as intermediary or not, and if they are qualified as intermediary, then they will be taxing that at 18%. So now they have changed the place of supply provision itself to treat that even though it is an intermediary, you are eligible for zero rating benefit. Similar amendment has happened in respect of GST and post sale discount. So earlier, what happened before the amendment, there was a requirement that whenever there is a supply post sale supply, whenever there is a post sale supply, for example, if I am doing any supply which is whether I'm doing any supply, for example, let's take an example of cars itself. I am having an agreement with my manufacturer in respect of certain sale of cars, you will be given some discounts. That is basically supply discounts given after supply. Okay, so whether that post sales this supply, whatever I am doing, is it, can I raise a credit note for the post sale discount for the purpose of reducing the value or not? Okay, that was the discussion. Now they mentioned very clearly that post supply discounts are allowed subject to a clause that in any of the agreement between the manufacturer, between a dealer and OEM, they should specifically mention that this particular discounts will be given after the supply has been made. Now, there was a lot of litigation going on in this aspect that agreements were seen. There was no clause mentioning specifically about the discount. There was clause about the discount, but the discount clause was very generic. A lot of litigations and a lot of advanced rulings were going on in this regard. Now, what government has done, they told very clearly that there is no requirement to have an agreement in place. That means even if you have given a post-supply discount and for that particular discount, you are issuing an in GST credit note under section 34, that is sufficient compliances. The only thing what you have to ensure is the recipient in respect of that credit note, GST credit note under 34, ITC in relation to that same has been reversed. Okay, that is a major change. The major litigation has been handled by way of amendment in this law, wherein there is no requirement to have a pre-sale agreement. In spite of no agreement being present, we can still give post-supply discount by this particular amendment in the law. Now, there was a circular, earlier, which is now absolute, because whether the recipient has reversed the ITC or not, we will not be able to know because the system is not in place. Let me be very clear. GST portal does not have a mechanism for me to decide whether the ITC has been reversed by the recipient or not, because everything was delinked. There was no linkage available until now, where IMS has come into picture. Yes, linking is to the some extent linkage is available. So there was a circular wherein they put the onus on a chartered accountant giving a certificate for a value determined more than 5 lakhs. If there is a CA certificate, then we will be allowing you to reversal of ITC. That particular circular is not obsolete now because the provisions of the law has been changed without any requirement of an reversal. The circular 2126 by 2024 has been absolute and is of no use. Now what they have told very clearly that post-sale agreements does not require any, post-sale supply does not require any pre-agreements in place. And second, the ITC, what we are reducing for the credit notes raised by us, will be allowed. It will not be linked to the ITC reversed by the recipient, because reversal of ITC is solely the onus and responsibility of the recipient, not the supplier. So there is a circular which was issued immediately, after the press release, wherein they have highlighted a lot of litigations, they highlighted and also tried to close all the litigations in relation to the post-supply discounts. One was whether ITC is required to be reversed by the supplier whenever they are issuing a financial credit note. So now what is financial credit note? There are certain kinds of turnover discounts, volume-based discounts, which are given by the OEM to the trader or a dealer for meeting certain targets. That particular discounts are based on certain performance criteria which cannot be linked to the original sale of invoice or original sale of goods. Now, for that particular discount will be passed on by manufacturer to the dealer only by way of issuance of financial credit notes. Okay, that is a very well-known practice in the FMCG or the auto sector. So department always used to doubt these financial credit notes for two reasons, because it does not have an element of GST. Second, they used based on these financial credit notes, they were always telling the taxpayer to reverse the tax liability. They have clarified very clearly in the circular that because in this financial credit note, the original value of tax is not being reduced. There is no question of reversing the because the original transaction value remains unchanged. There is no question of reversing the GST liability in this regard. Second is, now whenever the discount which I told there was another allegation by the department that the discount received by the dealer is basically a consideration in his hands for making additional supply of goods by manufacturer. So they told that because the dealer is involved in meeting the targets, because the dealer is involved in supplying additional cars, the discount what is being paid by manufacturer is basically the consideration in hands of the dealer. So they are required to pay GST on that same. That also has been clarified very clearly as to the fact that this is basically a discount that is not a consideration in hands of the dealer. There is no requirement to pay GST in this regard. Then they also clarified in the circular that if there is any promotional activities carried out by a dealer for which the consideration has been paid by manufacturers for carrying out the promotional activities, then it will be a consideration. For this, GST is required to be paid by the dealer. So this is a very welcoming. This is very welcoming circular in line with the government objective to done away with a lot of litigations already going on. So this is a very good news for a lot of industries and business and consultants like us who were waiting for appellate tribunal to come. So what was happening that till now, after 8 years of implementing GST, the tribunal was not ready. The tribunal had a lot of challenges to get it implemented, right from the operational, legal, and the procedural aspects. But finally, the press release has clarified that they will be likely to have appeal hearing by end of September 2025, and hearing can start by December 2025. And the good news is also that they have also amended the provision. They have notified a due date for all the previous appeals which are pending to be appealed as 30th of June 2026. That means any appeal which is any OIO, order in original, passed by Commissioner Appeals, which is not been appealed or which is still pending, we can file appeal till extended due date of 30th of June 2026. So the original time limit of 3 months will not apply. It will apply only extended due date of 30th June 2026 has been given by the government to ensure that we are not missing anything, missing our opportunity to file before appeal before the tribunal. This is very important for all the taxpayers because a lot of the taxpayers were directly approaching High Court for small matters. Because tribunal is the final fact-finding authorities, we believe that a lot of cases will be settled at this level itself and litigation level from GST will come down. What next? We have spoken truly about whether this GST 2.0 is historic or not and all those things. but and a lot of advertisements being done by media, government. The government has kept some programs like GST Samvad, GST benefit. A lot of things they have taken to like advertise this particular thing as an historic change. But as we speak today, what are the changes which we believe should also be implemented to truly make it historic from an industry perspective? One, they should have allowed refund for input services, which is currently restricted in case of IDS. So as we speak, renewable sector or any sector where inversion is available, government by way of law has restricted ITC on input services for the purpose of claiming refund. So I don't understand his logic for that matter. And because of this, even in spite of getting IDS refund from GST government, we are still having ITC accumulated in case of those sectors where service input is higher. So they could have relaxed this by including input service into picture, or by definition changing the definition by including input services net ITC also into this. Second is rate rationalization. So rate has been rationalized, benefit has been given to the customers, but what happened to your vision of correcting the inversion to those industries where access has been removed? So there has been lot of confusion in this regard, where government has to come up with certain solutions because the industries will be badly impacting in this regard. So this is from my side. If there are any questions, I am available to take up and take things forward. So Pareshji, how is the question answer setting in